if you can do principal only payments, you get a 6-figure deal every time. If it's free and clear and you do what I just did, every time 6 figures and higher on these deals. It's super lucrative.
Hello, everybody. It's Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of 6, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I'm not going to lie to you. It's freezing down here today. What's going on? It's 45 degrees outside, dude.
Dude, we got a guest from Boston on. I'm in Tennessee wearing my level 4 Sherpa right now, so I don't want to hear the BS. We're going to get right in it. We have a very special guest today. Today's guest is Chris Prefontaine. Chris is the best-selling author of Real Estate on Your Terms. He's also founder of smartrealestatecoach.com and smartrealestatecoachpodcast.com. So without further ado, Chris, welcome to the show.
Hey, thanks, guys. And I don't know what you're talking about. The cold. I'm up in Vermont, and it's -2.
-2. That should.
Humans are not supposed to live in that kind of environment. He is so far north of the wall. All right. Anyways, let's get this kicked off. Tell us how you got started in real estate.
I'm going to date myself, but 1991 started building single-family homes in what we called infill subdivisions. So we just kind of picked the onesie-twosie lots. We'd place a sign on it. We would wait till we found a buyer, build the entire house with everybody waiting to get paid. At the very end, when the buyer got their financing and then loan, the owner got paid and all the subs got paid. So we were doing terms before we knew what the heck terms was. Bought a Realty Executives franchise in 1995, sold that to Coldwell Banker in 2000, and then started working on my own deals and coaching people around North America, all the way leading up to the lovely debacle of 2008, where we got our head beat in a little bit. And here we are.
So what happened after 2008? What changed after 2008? Or did anything change?
Yeah, a lot. Yeah, we re-engineered what we're doing today is because of that. We re-engineered our entire business, and that means we don't take out bank loans. We don't sign personally. We don't borrow money from investors even. We just do everything on terms, lease purchase, owner financing.
Wow. So, okay. So let's go into owner financing. I love owner financing. So tons of questions right there. What kind of deals are you looking at? You looking at single families, multifamilies? Let's start off with that first.
Yeah, good question, because as you know, guys, the owner financing means a lot to a lot of different people. We focus on free and clear, mostly singles, to your question. Done several multis. As long as it's free and clear, we can structure the same type of deal. And
define free and clear for the folks.
Yeah, sorry, no mortgage. The people are debt free. About a third of the properties, roughly speaking, in U.S. are debt free. I don't know the stat in Canada, but that's a lot of properties. I was speaking to a woman in, I think it was Naples, Florida. She was a mortgage broker, and I told her that stat, and she said, "Oh no, it's like 56% here." Yeah. But it just depends. It is a lot of. So if you fish in that pond, typically, if they needed cash, they would have yanked it out, right? So they're usually in a good position, and they're usually very open as long as they get their price to what we do, which is principal only payments every month. Principal only. So we can pay the full price or premium, because in several months we'll get back to price by making principal payments every month. We've done that on almost every single deal. The only one that was a combination of principal and then amortized later was our own office building that we're in.
It's like the reverse mortgage thing that I see on TV, Gino.
There's a lot of moving parts here. So I want to dive into the strategy. First is, how do you find these deals? I mean, who are you marketing and where are you finding the deal flow?
Two tiers. All of our leads for all our deals come from for rent by owner, for sale by owner, and expires. So some of those will creep up and say, okay, they're free and clear. However, when we either have some leads drying up or we say, hey, let's put a push on, let's find more in this particular area, we just do a mailing. You can buy lists of free and clear property. I mean, you can buy lists, as you guys know, of anything now, but that's a great list to buy. I love free and clear and out-of-state owners, for example, because then you have kind of a double whammy. And they're usually very, I don't want to say sophisticated, but they got to where they are debt-free because of something, and they're usually open to creative ways.
So I just want to, for the listeners out there, elaborate on why only free and clear. I think that the why there is going to be important for folks.
Yeah, I want to be able to structure, I can buy it subject to some existing financing, but I love it when there's no mortgage, no liens, and I can pretty much craft the deal or engineer the deal. And more importantly, I can craft it with my principal only payments. Could you do small little loans on properties and search that list? Sure. I just don't see a reason to do that. It just clouds the water a little bit. No other reason. It's just simple.
So give us like a brief, start to finish on a recent deal that you did, how you found it, and just walk us through it. I think it'd be interesting for folks to hear.
I'll give you a great one and then I'll set up a rule that I tell everyone, because this one's only this guy called, it was an expired listing that we had reached out to. He called us back. This was several years ago. It was an estate he was liquidating for his dad. So like 5 properties in a town where I grew up in. So I knew the area. Come to find out, the brothers in the family, which is normal in the state, said, no, we just want to cash out, because everybody gets greedy, right? They want to just get their cash out. So I went away. He went away. I got a call on a Thursday afternoon or a Friday morning and said, hey, remember me? Yeah, okay. So he said, I want to do that owner financing thing. The brothers didn't want to deal with you back then. It was like a year before. But I got 1 house left, and I'm relocating to South Carolina. Can you come do that thing? It didn't sell in the market. I said, sure. When are you leaving? He said, Monday. Like he was going. He was having a going away party, and they were leaving. My son and I showed up on a Saturday. He said the house was on the market for $219,900 with a realtor. And so I asked the same question I ask everyone. What did you think you were going to get if the realtor sold, you paid the commission, then you paid some costs? What did you think you were going to get? He said, well, a full price offer would have been $183,900. I just ran out of time in his pocket. I said, okay, we'll pay you $183,900. We'll structure $923 principal only payments. We signed the agreement on the spot. He left. We did the rest by mail and electronic. We then had committed. We didn't say it's contingent upon a buyer. We committed to buying it, but $923 a month, principal only. We then put a tenant buyer in that. If you want to talk about the exit, or do you want to stay on the purchase still?
No, let's go on the purchase, and then we'll jump into the exit. Yes, I like that.
So now this deal gets interesting on the purchase. So I asked if I'm going to go deeper. So we structured a 48-month term on a $183,900 house. If you just do the math for 48 months times $923 a month, it's a nice principal pay down. But what we did the second year and the third year, right around Christmas, we do this a lot, is we called up the owner and said, hey, if we prepay some principal, not a fee, not just if we prepay some principal, $6,000 worth, will you extend it another year? So now we get another whole year of $923.
Fixer J, Gino.
Yes.
So then the next Christmas, they reached out to us and said, hey, do you want to do that thing again? We said, sure. We did another year. And now that brought us to last Christmas, this couple months ago here. And we reached out to them and said, hey, we got another idea. You guys have been getting principal only for these years, and the balloon's coming up in a few more years. How about if we add 4.5% interest and extend this 15 years? They retired in South Carolina. They wrote back within 24 hours and said, our accountant loves it. Go ahead and do it. So this deal became a 21-year deal, all from a 4-year deal. Now, here's the punchline, though, and then I'll wrap up the purchase. The 4-year deal, if we just stayed with that, the way we exit, is a $127 or $28,000 deal because of principal pay down and markup. And what I tell people is $200,000 and higher purchase price, roughly speaking. If you can do principal only payments, you get a 6-figure deal every time. If it's free and clear and you do what I just did, every time 6 figures and higher on these deals. It's super lucrative.
Wow. So there's a lot of stuff I got to dive into. Jake, where do I start here? So I got to peel back the onion. On that deal, so what terms are you looking for? Well, first of all, you take title of the property, right? I mean, you're taking
regular closing. Instead of getting a loan, it's the mortgage take back by the seller. Yeah.
Okay, so you're getting. So then, what objections do you get from people you're trying to do this with? Because he could have said, you know what, the broker's got it for $219. I'll drop it to $169 and just try to sell it off that way. What objections do you get from sellers saying, I don't understand that, or how is it going to work for them?
Usually just interest. If we get it, it's interest. Second is down payment. So if they say, well, how much you putting down? I say, whoa, you said you wanted top dollar or even a premium.
Terms or price, baby. What do you get? Terms or price? You know what I mean?
Very simple. And frankly, in the free and clear, that's why I like fishing in these waters. The free and clear, for whatever reason, it could be ego, it could be financial. They are stuck on price. If they get their price, they're like, tell me how you can structure this. And that was his deal. So
you're renting these out, right?
We do rent to own, so we eventually cash some of these out. If they're longer term, we'll drag our feet or rent it first, or but most of our cash outs are rent to own cash out.
So Chris, this is very similar to multifamily in one respect, that it takes a little while to get the snowball rolling, correct? I mean, like, how do you get students or people to do this? Because for us, it's a long time frame for you to find the deal, learn the education, get it going. How do you tell people, hey, this is a long game, let's play the long game? Because it might take you a couple of years to get one of these houses that have appreciated in value, have paid down a little bit. So what objections do you get from that angle?
From the student angle, kind of?
Yeah. Yeah.
Yeah.
Just from the investor angle.
Okay. So, and I'll give you some time frames. We work constantly on with our what we call our associates who we do deals with. We work constantly on how quickly can we get them to a deal, but still manage expectations. So we're not some, oh yeah, you can, it's overnight. So we
Mm-hmm.
used to tell everybody 6 months to get to payday one. We have 3 paydays per deal because it's an upfront deposit, it's the monthly cash flow, and then of course what you were referring to, the cash out. So it's 6 months to get to hey, I got my first deal in the contract, now I can get to a payday one. However, we're tightening and as a company, as a mission, trying to work on that. And we've got several down to like 90 days. Seems to be about as tight as we can get it, depending if they have any experience or not.
So let me just repeat that. The 3 paydays is number one upfront, right?
Yeah, upfront deposit from a tenant buyer, non-refundable.
Okay, that's number one, everybody. Number two is the cash flow from the deal, correct?
Yeah, so in that house, let's be specific, 923 going out to the seller every month. We got 1,500 in from a tenant buyer, and there's an insurance payment in there, right, for like $80, but that's the spread.
Okay, and number three is the cash out, correct?
Cash out, which is two things. It's the markup. We put that house out at 225, and it's the principal pay down, which is huge. So that's the
Yes.
back end. And those 3 paydays for us, to give you a number, just our family team locally, is about 78 grand now. Our students range from a low of 45 grand up to as high as 200, depending on what market they're in, price wise.
So what price points are you trying to look for in houses? What's the sweet spot in this?
Sweet spot is median in your market. So for us, it's probably the 299 to 699, in our area. We deal in Connecticut, Rhode Island, and Massachusetts primarily. We do. And then we have students in, got about 80 of them. So there's probably another, I don't know, 20, 25 states in there, So we do see a lot of different markets and prices, but median.
Would this work with self-directed IRAs? If somebody has a self-directed IRA and they want to invest money in it, what vehicles does it work well?
It worked sweet. I did a 6-unit in mine because here's what I tell the students, once you get your portfolio, your payday ones and twos flowing, and that doesn't, in the first year, say you have 12 of them, you have 12 deals kind of flowing at different levels and different cash outs. Once you fixed your cash flow with that, whatever your cash flow break even is or your family needs, then why not plow them into the self-directed?
Mm-hmm.
The 6-unit, we put $500 down, and the cash out several months ago was like 116 grand. Well, why not do that all day long in those?
Mm-hmm. Wow. So what can go wrong with your strategy as far as market conditions and as far as tenants and all that? Give us the down dirty on it.
Yeah. And in my book, there's a chapter that says what can go wrong, because we're pretty candid and open with our team. So here are a couple of things in no particular order. When we and our students now, because we've learned, don't pre-screen the buyer tightly, including getting a high enough down payment so they are truly a buyer, not a glorified renter. That's a headache. You have a renter unless you're getting a strong down payment. And their scenario is such that, no, I was trying to buy, I had this little kink, can you help me? And I need some time. Not, I'm a renter, someday I'd love to own, and I got a mess behind me. So that's a headache if you don't do that right. Pre-qualifying, setting them up to be mortgage ready and monitoring that.
Mm-hmm.
What's the time frame on that?
It ranges from a low of 12 months closer to 24. If we have a house, Jake, where we don't have a tight time frame, like we don't have a tight 36 months with the seller, where we have to really watch the buyer. If we have a longer one, like we just talked about, we won't put our foot on their back and pressure them, and they'll take longer. But if we're pushing them, it's 18 to 24 is pretty normal cash outs. Yeah. So that's one headache. Second headache is, and we've learned this the hard way, is taking on properties that have some pre-existing conditions that you don't inspect or you don't touch, like lead or asbestos or something like that you now take over, because you take over responsibility for this house. So we've kind of tweaked our agreements to safeguard that now from learning, but we've also told the students, look, before you even do a lease purchase, never mind buy it, you really should be doing inspections and making sure you're agreeing with who's taking what before you dive with both feet.
Mm-hmm.
Those are the two things that come to mind. The other thing is a market dip, right, Gino, to your point? So all our contracts are set up to say, okay, if the market dips on the buyer side, there's no contingency in front appraisal. You have two choices. You put up more money and you close it, or you get an extension with us and keep renting till you want to close, or you take off and lose your deposit. We haven't had that happen because the market's been flat or up. On the seller side, what happens? On the seller side, we call and get an extension from them, or it's written in our contract. We literally can say, here's your house back. So there's a good flexibility with that. No one wants it back, so they all work with you on the date.
Mm-hmm.
That's reality.
So you get inspections on these houses before you go and you purchase them?
We do now. Yeah, even though I've been in the business for 29 years, we do now because A, I want that in writing, and B, I want the seller's disclosure as well, the state legal disclosure. So then everybody's on the same page and we know who's fixing what if that's the case.
So that upfront fee is an option. Somebody that wants to rent a $200,000 house, what do you normally charge? $5,000 is an option to hold that down, and then when the 24 months or 36 months are up, you credit them that fee to buy it. And if they don't buy it and they leave, you keep that money. Is that how that works?
You said the flow right. Yeah, we call it a down payment. So it's a non-refundable down payment. If they default, it's gone. If they exercise it, it goes against the price, just like you were buying a home today and writing up a standard purchase and sales. We do, however, in our videos, in our education with the buyers, say, look, it's going to be 3 to 10% because we want you to be mortgage ready. We want you to be in a good shape. And if it's a jumbo loan, it's going to be higher depending on what market they're in. So we just want to make sure we're setting them up to win, not to have a shortfall at the end. But also, if they are only coming with 3%, not the 10 or 5 or 7, then we want to make sure everything else we like we liked them when we met them, we like their work history, like all that, and we like their ability to move that 3% up over the course of time. So we're real good. My son Nick runs the buyers. He's real good at getting every February or March, for example, is a big time for us because tax refunds come in and they commit, hey, I'll give you 50% of this. This is usually what I get. That's a big one. State Trooper had some retroactive sergeant pay he knew was coming quarterly. He committed some of that to, so we schedule it out so they get more and more vested in the home as time goes on and get up to that 7.5 to 10 is pretty normal.
Chris, how do you scale up the business? Is it hard with all these homes all over the place and all these payments coming in and all these tenants and who's selling what? How does that work on that aspect of it?
It's not hard to scale because we've done it. I mean, I started myself and say on terms only in 2012, and now we've got my son-in-law, and one assistant. I'm pretty much removed from the buying and selling now. Zach and Nick run it, and then Sue just became full time. But we run 60 properties at any one time, coming and going. Keep in mind the big thing about running those is it's not like a rental property. The tenant buyer takes on all responsibilities like they own it. So our discussion is like this: you guys are buyers, and I say, look, guys, you're going to be acted like, treated like, and pay for like, and capture equity like you're a buyer. So I'm not a landlord. I'm an awful landlord. You're a buyer. And so without the headaches, 2% of the time, 3% of the time, we get headaches. People have life events. But for the most part, they're buyers, and they're treating it like that with ownership, pride, and putting money into the property. It's amazing. So you're not getting the cranky tenant calls. You're just going to get it. They have a life event, and those happen. Every year we get a few. Divorce, death, out-of-state stuff happened. They had to leave. We've had it all.
So the buyer takes care of cutting the grass. They take care of a lot of the stuff. So basically, you're just paying taxes, insurance, and just handling that stuff, and the buyer handles everything else.
Yeah, we're usually paying on a lease purchase the underlying debt to the mortgage company in the seller's name, and on that owner financing deal, we're paying the owner for their mortgage, we're paying the taxes, and we're paying the insurance. However, the taxes are getting built in on top of the lease payment, so they have a base lease that we advertise. They're educated in our videos and in face-to-face buyer meetings that you're also I'm gonna call it a lease, but here's where we came up with the number. We took your base lease and we added the taxes. Why? So we can educate you on how home ownership works. And they all go, okay, I get it. I looked at your video, I understand that. So because they need to know that when they go to buy, they're gonna have the loan and they're gonna have taxes.
So Chris, you must have a lot of people out there saying to you, this is not going to work. There's no way this is going to work. So how do you, and let me ask you, who's your persona?
The numbers work, man. It's there. It's obvious.
It's obvious to you and me and Chris, because we're investors and it makes sense to us. And how do you get somebody over the hump? And who's the ideal investor to go into this space?
Okay. On the first question and then the ideal. People say that probably not now as much, Gino. I mean, maybe in 13 or 14 when I started, but we've now got 80 some odd associates around North America, not just the country, and they're just, the proof of income is crazy. And so it doesn't matter what market you're in, you can do it. It doesn't matter if it's going up, down, or sideways, you can do it. The ideal person, frankly, is probably the coachable person. It's not in particular makeup. Now, what have I seen in general? If I look across all the associates that are doing deals, financial background seems helpful. Believe it or not, engineering background, because they come at it very conservative, very calculative. They don't take on garbage buyers. They just seem very planned. Those come to mind, but doesn't mean that's the only people, right? We get people who have been, I got one guy who's been a commercial leasing agent for 28 years, and he came and found us and loves this. And then we have people that never touch real estate. Many of them never touch real estate and doing it part-time. So it's just, are they coachable? And are they are they the type that can manage expectations and not let the shiny object syndrome, as you guys know, pollute what they're looking at? Because I tell people, commit to 36 months. I'm not saying it's going to take that long, but if you come in to try this, don't come in. You're not ready. Do your due diligence, and when you're ready to commit 36 months, we'll have a great experience together. But I need you to put the blinders on for 36 months.
So Jake, is he saying to stay in his own lane? No Bitcoin?
No,
crypto?
he's totally.
Yeah.
We say the same shit all the time because it's like if you're gonna like go and dabble, it's not gonna work. You know, a lot of people are like, oh, this is a pie in the sky. It is if you think that, and it's gonna take time to do this stuff. What I love about this is it's creative. It reminds me of a hack. You're thinking outside the box, and you've almost created a franchisable model. So there's a lot of good going on here. I'm really impressed with this. I think you've done an awesome job.
So
I
before
appreciate it.
no, I was
Okay,
gonna say, before we get to the short answer questions, what are your goals to do this? Your goals to continue to create associates, you continue to expand your portfolio. Like, what are your long-term goals with this business model?
Okay, so twofold. One is on our own buying and say our investment companies, locally.
Mm-hmm.
We now look for, I was just telling one of our associates this, there were times when I would do 10 deals in a month. I would take 10 new deals on in a month. I'm not at that mode anymore. We've got a nice portfolio. We look for like 1 or 2 killer deals a month now that are like 6 figures and above. So very calculatively. We also look for more ownership, like we just talked about, versus lease purchase. We do both still. But we're looking for longer term and bigger profits. And then on the associate side, on the Smart Real Estate Coach side, real simple. We've got a mission that started 2 years ago, goes till 2022, and that's to help the associates cumulatively do 1,500 transactions. So we're not based on, hey, let's try to sell this and sell that. We are solely based on, let's do deals. And too many people in the real estate industry aren't doing that, and they're just selling stuff. So that's our mission. We're at about 12 to 15 deals a month right now with the associates. So we're getting there. It's at a nice clip, and they're super happy. So those are 2 kind of missions of both ends of the business.
That's awesome.
Sounds good. All right, gang, let's take a quick time out to hear from our sponsor. Gino and I are super excited to tell you about the audiobook version of The Honeybee, which was recently released.
The Honeybee tells the story of Noah, a disappointed, disaffected salesman who feels like his life is going nowhere until the day he has a chance encounter with a man named Tom Barnum, the beekeeper. In his charming, down-home way, Tom, the bee man, teaches Noah and his wife Emma how to grow their personal wealth using the lessons he learned from his beekeeping passion.
In the audio version, Gino and I sat down for an exclusive interview after each chapter where we elaborate on the stings we felt throughout the business, the importance of scaling up, and how we've been able to create multiple streams of revenue.
For more information and to get your copy of the audiobook, visit jakeandgino.com/honeybee.
All right, Chris, what is your best habit for success?
Daily routine, I would say. Everybody has different ones, but daily routines for me, it's either a combination or one of these: working out, meditation, or yoga. I usually combine 2, and then ending those with journaling. It could be just 2 minutes, but just thankful journaling, gratitude journaling.
Mm-hmm.
What about a tip for someone starting to scale their real estate business? What has been a successful scale tip that you've experienced in your journey?
I'd actually say on a broader scale, because it'll help with scaling, but on a broader viewpoint, it would be kind of alluding to what I said earlier. Find a niche, whether it's apartments or, I'm not so naive to think we're the only niche, right? So find a niche, number one. Number 2, find someone in that niche that's kind of doing what you want to do and scaling, if that's what you want to do. And then 3rd, what I said earlier, commit to 36 months. If you do those 3 things and you put the blinders on and don't look left or right, you're going to have an amazing experience. I don't care if you're going to go open a restaurant. If you just do those 3 things, you're going to have an amazing experience.
That's fantastic. What's the biggest mistake you've made in the real estate game?
Pre-08, signing personally on loans because I had good credit and thought, why not? I can just go out and, sign personally on all these things. What a freaking headache. Because where's the bank going when the market goes down? They're knocking on your door. Don't sign personally.
Gotcha. Book recommendation.
Oh, there's so many. It depends on what time of year it is. I like the Under the Arches or whatever the name of it is, the McDonald's story, and then they made the movie, or vice versa. Because
The Founder?
That was the movie, yeah. Because the book's like, really thick. It's because it does real estate, it does scaling, it does problems he had, and you go, whoa, I don't know how he made it through that. Like, there's a lot of cool things in that book to learn from.
Mm-hmm.
Excellent. Haven't got that one yet. What project are you excited about right now?
Scaling the associates, the volume we just talked about. It's exciting to see that all around North America, proof of income, and to see people go from literally a 70 grand job to their first deal surpasses that. And that's we're working on more and more associate transactions.
That's awesome.
That's great. You have a giveaway for the listeners, and you want to tell folks how people can get a hold of you?
Yeah, so they can just go to smartrealestatecoach.com. If you want to deal with listening to me for another hour, you can go to the free webinar. I'm big on, as I said earlier, for the listeners to know, free until you decide which direction to go. So go camp out and do the webinar, go on YouTube, look at all the stuff and see what you want to do. The book is really what we've been talking about, but a lot more in depth. It's the Real Estate on Your Terms. It's a hard copy, hardcover book. It's not, hey, get this free book and then pay for shipping, put your credit card in. We will ship it. It costs us $6+ to ship plus the book. Just go to free, FREESRECbook.com, freesrecbook.com. Just say that you are on the show with Jake and Gino, and then we'll get it off to you.
Very cool. Gino, what else you got, man?
Well, I think this is great. I think they should go to the webinar and watch and listen, because being creative will lead off into the multifamily space, because Jake and I are doing a deal right now. We've done owner financing in our deals. And just to be able to think creatively, it's not all black and white. It's not all fits in the box. And especially in this type of economy, Jake, right? In this type of market where you're creative. We just had a student yesterday. We had a weekly lesson yesterday. The student did a 64-unit deal. He bought a deal for 64 units for $1.7 million. He had his father owner finance it for him. So his father's getting money. He's going to cash out refi this bad boy for, he's going to cash out. He's going to go to a community bank. And then from there, 18 months later, he's going to go to agencies. So this strategy works in multiple different niches. So I think in anything, get educated, get outside your comfort zone. And Jake, it's like when you go to a business, I give you an example. I went to a restaurant about a year ago to get my son to work there. I sit down and they're onboarding their employees. And I think everyone, when they go to a certain business, it's all interrelated. So this niche definitely works. And what we did is we took their onboarding process and used it for our company. So when you're going into different industries, wasn't it great, Jake? I love that, dude. Beautiful system. But go in there and have an open mind, and don't go in there by saying this is not going to work, because obviously it does work. Chris has been doing it, and it's been around for a long time. So get on the webinar, get his book, read about it. And even if you don't go into his niche, you can use it in multiple other niches. So that's exciting. It's a really cool strategy.
Chris, AKA the Ray Kroc of single family residence. I like it. Chris, thank you so much for your time today.
Yeah, thanks
Chris.
for having me on, guys. Great to see you again.
Take care, everybody.